During these weekly talks for the month of February, I've been saying that the U.S. equity market was likely to be very resilient to bad news because U.S. companies were going to be reporting very strong fourth quarter earnings. And of course, that turned out to be correct. In fact, the earnings were much stronger than even I thought they would be. According to FactSet, fourth quarter year-on-year earnings growth is going to be about 16.9%. That's almost double the rate of earnings growth that it usually does on average. So we've had this very good, we have this backdrop of U.S. companies reporting really strong earnings. And even if you had some bad news on tariffs, bad news on DeepSeek, bad news on inflation, it's very hard for the market to sell off when you're getting all that positive reporting. However, the other thing I was saying is once the companies start finishing reporting their earnings, then you don't have that constant impetus of good news or the constant good news from corporate reports. And if we have some additional bad news, the market is likely to be much less resilient and have a pullback. I really didn't think that we would have anything that could cause the market to do as much as a correction, which is a 10% decline. So I specifically used the word pullback, and I was thinking of something, a 5 or 6% decline is something that certainly seemed like it would be in the cards. Lo and behold, since last week, the S&P 500 is down about 2.7%. So we've had a little bit of a minor pullback. If we have some more bad news, that pullback could grow a little bit. But right now, things are kind of going sort of like what I expected them to do. What is the bad news that's caused that pullback? Well, the bad news really isn't that bad. The first bit of bad news came from Walmart when they reported earnings. Their forecast for forward sales were not as strong as expected. That disappointed the market. The next thing we had was the University of Michigan Consumer Confidence Survey. That showed a bunch of weakness. And the last thing, we had the Conference Board survey of consumer confidence, and that was a very disappointing number. We got that last night. Some people might assume that consumer confidence numbers are really forward looking, because you're kind of asking people a bunch of questions of what their perception of what's going to happen going forward is. But that's not really the case, because people are reacting to what they see around them. So if they see their colleague getting laid off from their job, they're going to say, "Oh, I don't feel so confident about the labor market." Consumer confidence numbers indicate that there has to be some slowing going on in the U.S. economy right now. And that will go into what we see going forward on inflation, which of course is another big issue on the market. The market, if you look at the Treasury market, they certainly seem to expect that the economy is going to slow down, and that's going to reduce the rate of inflation. Although I kind of characterized the move in the equity market, a 2.7% drop, as not being something very major, the decline in the 10-year Treasury yield is like 25 basis points. Last week it was at about 4.55%, and now it's at about 4.3%. So that's a very significant move in yields. So when you see those yields down, obviously if inflation's going to be bad or continue to be high, you wouldn't see yields declining in that way. So on Friday, we have the the Fed's, what they always call the Fed's favorite inflation gauge, PCE data. If you remember earlier in the month, we had CPI data that was hotter than expected, showed inflation going higher than expected. For the PCE data, because it's harder to calculate the PCE, that's a little bit of a stale piece of data, because it'll tell us about inflation in January, and on Friday will be, I think, the first day of March, right? But anyhow, That's expected to be 2.6%, which is a decline from 2.8% in December. So the market is expecting it to show an improvement. And of course, what I just said about the Treasury yields falling so much, the Treasury market is saying, hey, we think the inflation is coming under control along with growth slowing. So the market is really looking for a good number, or at least that 2.6 number in the PCE report. If we get a higher number than that, that means the economy is slowing in the US, but inflation isn't necessarily coming off. That's not a nice combination. One set of numbers, the market's not going to price in stagflation from just a couple of different numbers. You'll need more evidence of that. But if you get a bad PCE number, it'll make people start talking about stagflation, and you'll probably see further declines in the equity market. And back to what I started at the beginning, that 2.7% pullback might easily become a 5, 6, or 7% pullback. I'm going to leave you with the last little bit of forward information on the calendar. It's Wednesday afternoon here in Singapore. Wednesday night or Wednesday evening after the close in the US, we had Nvidia reporting earnings. I think the market assumes the earnings are going to be very good, so it'll be mainly what kind of comments that they make about their chip sales, their new products or whatever. That's what the market's got to focus in with Nvidia. The one good thing that we've learned in the last several months is that Nvidia shares, which of course this is a multi-trillion-dollar company, it's extremely important to the market, but it's not so important. We've discovered that that Nvidia shares can drop and the rest of the market can go up at the same time. So it's not as critical as some people thought it would be. That Nvidia is not that critical to the market as perhaps even I would have thought it would be, several months ago. So anyhow, it's coming out tonight. It'll be very closely watched. Expect it to be very good earnings. If the general comments on the call are positive, since the stock's been pulling back, I would look for a little bit of a rebound.